You gotta ask me nicely.
All right, folks. Somebody asked, I believe a couple of weeks ago, about what do I think about Ball Corporation. I thought it was an intriguing question because usually folks ask about what do I think about Micron or Nvidia or Apple, the popular names. But here we have a unique one with Ball Corporation. And right off the gate, I want to do the fundamental analysis, and then I want to do the technical analysis after that. We'll look at the fundamentals. I mean, a lot of folks could look at cash flow or assets and liabilities and the balance sheet. A lot of folks look at profitability. In these kind of companies, I'm looking for sales growth. I'm looking for the growth rate in gross profits year on year. Now, why do we look at the growth of sales? I mean, it comes with the territory that if you're looking for a company to invest in, you need to see a positive trend in the growth of sales. And of course, sometimes the growth of sales depend on how the company executes, be it the marketing strategy, be it new products that incite consumer spending. But of course, in a corporation like Ball, where we don't have a lot of innovation, it's pretty much a strictly packaging company with a segment of aerospace, which is kind of weird to say the least. A packaging company does aerospace, but anyways, what we're really looking for here is maybe the company hit a rough patch in the growth of sales. Is it getting out of that rough patch? Is it improving year on year? That's what we're looking for. Now, when it comes to the measures of profitability, a lot of folks love to do net income. Not my favorite. The reason is you can manipulate net income really easily. Just talk to any accountant. So the other category is operational profit, which is usually the go-to because we want to see how companies being profitable based on the operations alone. Forget about amortization, depreciation, and all of that crap. Taxes, we can play with that. Now, the reason why I'm not using operational profit here as a measure, and I'm using gross profit instead, operational profit will be relevant if we had an expense problem with the company, such as higher salaries or more headcount that they need, and we're not seeing any of that in this company here. So we're going to stick to the gross profit, which is, okay, we have a number of sales, deduct the cost to make the sale, the cost of the product, and you get your gross profit. And the reason why we use that in a company like Ball, because it is sensitive to the rate of inflation. And right off the gate, looking at the sales growth in red, we can see that the company had a rough 2023. In Q1 2023, down 6%, Q2 down about 14%, Q3 down about a little over 9.5%. In Q4, we see that those numbers getting improved a little bit, only minus 4%. Comes 24, we're now minus 3.5%, whether it's Q1 or Q2 of 24. So we see improvement, and the improvement will be easier because the numbers in 23 were abysmal. So the company will at some point be able to register a positive number of sales growth. But that's not because the company is selling more. It's happening because of the base effect. And that makes the rate of growth in sales not as relevant as the gross profit. That tells the real story of the company. And here we see that Q1 23 all the way to Q3 23, we're not pretty good. We're negative 8% in Q1, negative about 5% in Q2, barely positive in Q3 23. Then we have the anomaly of Q4 23 where we've seen gross profit going up by 35%. Now it is stabilizing at about 6.5% in Q1 and Q2 of 2024. Shall we say improving numbers? Yes. But the problem is the stock market price is what's going to happen next, not what already happened. So if we want to buy the stock right now, what do we see based on these trends in the future? Well, we just talked about the rate of growth in sales. That's going to improve because we have low numbers from 23. But what about the gross profit though? If you're looking at the trends of the company, why 22 all the way to 23 were rough years for the company. The reason is inflation. The rate of inflation, the higher it goes, there's very little they can do in terms of increasing their sales. This is not a company that enjoys pricing power. When there is an increase in inflation and you're doing packaging and bottling for aluminum cans, if you charge more for that service, then whoever the customer will find another provider. And this is why the enemy of a company like Ball is a higher rate of inflation. Now, where we're heading in the economic picture right now would be lower inflation, at least that's the assumption right now. But we also have weakening of the consumer, which will be rough for the growth of sales, even though the numbers will be friendly, but it's going to be restricted by the weakness in the consumer. Now, the worst thing that could happen to a company like Ball, if we see weakness in the consumer and the Federal Reserve begins cutting rates, and then we see the dollar going down dramatically, causing inflation in commodities, specifically aluminum, then that's going to be the worst of two worlds in a company like Ball, because you got weakness in the consumer, and you can't improve your margins anymore because of the increase in aluminum prices, in oil prices, whatever commodity that goes into the production of Ball. So from a fundamental standpoint alone, do you buy this stock? I would say if you believe that we will see consumer weakening subsiding, we're not going to see more consumer weakness, and we will see more improvement in the inflation picture, where the prices of aluminum go down further, the prices of oil, energy, transportation go down further, then that's going to be good for the company because the margins will improve. But if you don't see that happening in the economy, then it makes a bad choice for Ball as a stock to be bought. And if you look at the technicals right now, it's not a stock that is overly beaten or suppressed. It is way off the highs, that's for sure, but it's not trading at multi-year lows or anything like that. It actually been appreciating in value in the recent few months, even though the company has negative growth in sales. So there is a degree of overpricing here. And when we look at the weekly chart for BALL, we know that the 50 weeks moving average in blue is important. You can see it as a point of support, point of resistance before. So we know if we want to buy the stock right now, we have somewhat of what it appears to be a bear flag pattern. And the confirmation for that break to the downside will be losing the 50 weeks moving average. That is sitting right now at about 60. So if you buy the stock right now, you know what your stop loss. That's going to be 60. Once you trade below, you got to cut the investment or the position right away because it doesn't make sense anymore. The stock is probably going down because it either sees more weakness that could impact the top line, that's the rate of growth in sales, or it sees that inflation might go higher, and that would impact the bottom line, the gross profit. Now, if you don't want to buy the stock right now, where do you wait for validation? We'll look at the last point of resistance here, and it was 71.32. That's when the stock stopped before and turned to the downside, seeking support at the 50 weeks moving average. So far, so good. We got support. Now the next test is, we got a bunch of buyers who showed up at the 50 weeks moving average. Can they, this new energy of buying, can they push us higher above the last point of resistance of 71.32 where we've seen sellers showing up? So it's up to you whether you want to buy right now. And if you do, you know what your cut loss is. If you want to wait, then you know when you should buy after a validation of a crossing above 71.32. Now, I thought it'd be fascinating to talk about Newell Brands in making this video because believe it or not, when you think about Ball Corporation, you think about these mason jars, right? The glass jars with the Ball logo on it. Believe it or not, the company Ball is not the one producing those glass jars. That's owned by a company called Newell Brands. Ball does the aluminum cans packaging for certain soda producers. They do some recycling and aerospace business, but they're not producing the glass jars. So I thought it'd be fascinating to look at Newell as an alternative. Perhaps maybe it offers a better entry point than Ball. When we look at the growth of sales here and the growth of gross profits, you see similar trends as we see with Ball. So 23 was a rough year for both companies. More rough for Newell, of course, because you see the growth of sales down 24.40%. I apologize, by the way, if you can't see this, but we'll go over them again. Newell Brands, by the way, they do Mr. Coffee and Rubbermaid, all of these containers that you see and you probably own in your kitchen. But anyways, the growth of sales down 24.40% in Q1 23, gross profits down 35%. That was the bottom, and after that, things began to improve. And we've seen the latest quarter, they actually made 11% in gross profit, and sales growth, sure, still negative at minus 7.8, but still better than the quarter before, better certainly than Q1 or Q2 of 2023. So we will see the same phenomenon in Newell Brands as we will see in Ball, which is the law of numbers. We're going to run into really weak numbers from 23, and we will see improvement. And we've already been seeing improvement in the rate of growth in sales. The problem is, since we bottomed in Q1 23, these numbers improved after that. So it's going to be harder and harder to beat. And we might go down to negative sales growth again, maybe -8, -9, and that could happen in Ball as well, because the numbers improved after, let's say, Q1 or Q2 of 2023. So it becomes imperative that in a company like Ball or Newell Brands, we're not really concentrating too much on the rate of growth in sales. We know that these are stagnating companies. They enjoy very little growth. So we look at the gross profit. And 11% is a massive improvement over previous quarters. Now, the difference that I see, we go back to the same conversation that we just had with Ball. What are the external factors that could impact the rate of growth in sales? Well, if there is a weakness in the economy and the consumer is not spending anymore, that's going to be bad for Ball, a cyclical company, and also bad for Newell in theory. But we've seen in the past that when folks, for example, when the unemployment rate moves higher and folks stay at home, they tend to cook at home more, and therefore they use more containers. That could be good for at least one segment of the business, which is, let's say, Rubbermaid. They have multiple other businesses, and each one will react differently in a recession. But let's say that the overall theme, a recession, weakness in the consumer, not good for the rate of growth in sales. What about the gross profit? Again, the cost of materials, the cost of transportation, cost of energy, that's going to matter a lot. So if we see a revival in inflation again because of the Fed cutting rates, both stocks make no sense at all. But if we must pick here, folks, we go head to head. Newell sales growth in white, and you got Ball sales growth in blue. You can see in the latest quarter, of course, Ball has better numbers than Newell, down 3.5%, Newell down almost 8%, and it's been outperforming Newell for a while now, at least for 2 other quarters. And we see the same trend here. But we talked about the sales growth not being as relevant as the gross profit growth. So let's do that. When we do that here, we see that both companies were suffering in 23. Of course, be it Ball outperforming Newell Brands. But now, as things improved and the rate of inflation went down, we see that Newell, at least according to the latest quarter, pulled in a better profit, 11% versus 7.3% in Ball. So if we're looking at this as the leading indicator for what's going to happen from this point on, where Newell will have better profitability, then Newell makes sense more than Ball. And to me, if I'm going to buy Ball or Newell, both companies will be impacted by inflation, the resumption of inflation, or of course, beginning of a recession. Both of them will be negative for the company. But if I must pick, I'm doing dumpster diving, and I want to look for deep value. We looked at Ball stock. It is way off the highs, but it's still trading way higher than, let's say, the 20 teens. But you look at the monthly chart of Newell Brands, the company's trading at the same price it was trading at back in the 80s, which of course makes the company a horrific hold in the long run. Maybe at some point they'll have new innovations and the company will rally higher and never look back. But I mean, it's been decades now. There's no innovation. We know that this is a company that pretty much, it's a cash cow. It's a company that relies on the rate of profitability and the volume of sales, which depends on the health of the economy. It also depends on trends. A lot of folks are not using these products anymore as they used to before, let's say 10, 20 years ago. But if I'm looking for an investment between Ball and Newell Brands, and I'm doing some dumpster diving, I'm going to go for the deep value here in Newell Brands over Ball, because I know that the company rebounded from this point on at least 3 times. I know that whatever bad story that's going to come Newell's way, it's already priced in perhaps. The worst is already behind us. And the valuation here is really cheap. For a reason, of course, the company has problems, but it pays better dividend and it's more established than Ball. It's more diversified than Ball. It's the kind of company that thrives, let's say, after the recession. As the economy heads into a recession, we're already in it. We begin to see the rate of inflation going down dramatically. We begin to see the rate of sales stabilizing, and the margins kind of improved for both companies. But I think it will improve more for Newell Brands over Ball because Ball has exposure, let's say, beverages that are sold in outdoor establishments. We're probably going to be focusing on eating at home during the recession, where Newell Brands can thrive. So Maverick 2 cents. I would avoid investing in both companies. I see many other better places in the market to invest in. But if I must choose between the two, I'm going to go with Newell Brands versus Ball, and the reasons would be it is improving the gross profit better than Ball. It is already hammered, bruised, beaten to the same price that it used to trade back in the 80s. It has better valuation, and it withstand the negative catalysts, or shall we say the headwinds that will come to the economy better than Ball. And that's my take.